It's a steady start for the Indian market on the back of positive global cues. Indices come off their opening highs, however. Metals lead the gains. Banks outperform while IT and autos drag.
Metal stocks are the top sectoral gainers as the dollar weakened. JSW Steel and Hindalco lead the way higher.
Brokerage house Motilal Oswal says Titan has a strong runway for growth given its market share of under 10% in the Indian jewellery market. Sets a target price of 31-35 rupees on the share, and the stock is up almost 2%.
Gland Pharma is down 10% on earnings disappointment, while Glenmark is also lower after its Buddy unit was placed under import alert by the US FDA.
Another stock that's tanking in trade is Chennai Petro on earnings disappointment, where gross refining margins falls from over $25 per barrel to a little under $4 per barrel.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me is Mangala Malu. Well, we made this point earlier today as well. We're going to see a gap up. Then taking some money off the table would be a prudent strategy. It appears that's played up because the 17,800 odd mark, that seems like a bit of a resistance zone. We went there earlier today. We went there on Tuesday's trading session. And even before we got into the weekend, that's on Moro Day, we went to around 17,780. And from there, we did see some selling. So that's turning out to be a bit of a barrier. But how do you trade from here? Ashish Kayal joins us to tell us exactly that. Hi Ashish, morning. Well, how would you trade the index at around 17,740 odd? Buying the dips has worked in this series. For today though, what are the levels you're looking at?
Hey, morning to you as well, Nigel and Mangalam. Looks like the overall, if you look at index, it's a very typical behavior where you are seeing past 3 to 4 sessions. If you observe closely, there has been gap ups, and the gaps are big enough, maybe 100 points, 150 points gap up, and post that it goes sideways and dip in the final hour. That is what the nature of the market has been so far. Even if you see what happened before the Mura trading day, the same similar kind of a scenario. If you see today, again a gap up, and now we are going sideways. Maybe dip will come again in the later part of the day. So in this kind of a market, you need to anticipate a move if you are trading positionally. So for me, this is still buy on dips market as of now, given that we are sustaining that gap area. So any move towards the level of around 17,680 can be used to buy this market, keeping a stop loss of around 17,620 on the downside, and then expecting it to again go back towards that 17,790 level. Looks like 17,800 is a major hurdle. It's not able to close above that. So 17,800 is going to be a hurdle. So buy on dips market with 17,620 as a stop loss and 17,800 as the target.
All right, take that point. Ashish, individual stocks, what's on your radar today?
The first stock pick is going to be Tata Steel. We can clearly see after a long time the metal stocks have been buzzing around, and we can see the top 3 stocks in the index itself is JSW, Hindalco, Tata Steel. And Tata Steel time cycle has also reversed on the upside, which is suggesting that the overall period for next 15 days can be positive for this stock. So one can create long positions here, keeping a stop loss of 100.80 for the target of around 112 levels over short term. And the next stock on the buy side is going to be Mahindra and Mahindra. We can see that the auto sector has been outperforming, not today, but overall, if you check, the auto sectors have outperformed despite of the crude oil prices or inflation and interest rate hike. These autos are outperforming, which is a very positive sign. It's bucking the trend, and Mahindra and Mahindra even today is up, so looks like it can touch that 52 high level again. So long positions can be created here. Stop loss at 1250 and target of 1385.
Right, Ashish, take that point. As of now, currently a couple of stocks which are weighing down on the index, which is Reliance, has been an underperformer on the previous trading session as well on Tuesday, and currently at the low point of trade for that counter. ICICI Bank too seeing some bit of profit taking after a big rally that we've seen on the stock this year itself, and importantly, good numbers coming by for that counter too. So the Nifty closer to 17,700 is where the smart money makes money, because that's where all the straddles, both the calls as well as the puts, are written. Let's now shift focus to our special segment where we get you a few ideas of profit coming in from our colleagues at Money Control Pro. Neha Dave joins in with a stock.
Today's stock idea is SBI. The leading private banks have reported a good set of numbers backed by healthy loan growth, better margins, controlled operating expenses, and fall in provisions. SBI is also likely to see a similar trend. The pickup in the credit growth for the banking system as a whole and the rising interest rate scenario bodes well for SBI and should support a healthy top-line growth for the bank. In terms of asset quality, The legacy corporate stress accounts are well identified and are fully provided for. The restructured loan book is also contained, and hence credit cost is likely to remain low for SBI in FY23, which will support the earnings growth. In terms of valuation, the bank is currently trading at around 1-time core book value estimated for FY24, which is very attractive considering that the return on equity has improved to double digit. Given its size and market share, end of bad asset quality cycle, and improved return ratios, SBI can command a higher valuation multiple. The improving performance of the bank's subsidiaries should also drive the stock upside. Investors should keep the stock on their radar.
Okay, thanks a lot for that, Neha. Well, on that note, though, we'll slip into a short break. You come back, we'll get chatting with the management of Signity Tech's CFO, Mr. Krishnan Venkatachari, will be joining to discuss the past quarter's numbers. Well, as promised, let's get chatting with the management of Signity Tech. In its second quarter, they saw revenue surge by nearly around 40% over the corresponding quarter, while the EBITDA margins as well did expand by close to 400 basis points. Well, that was fairly impressive. But to understand more about the past quarter, the way ahead as well, we're joined by Mr. Krishnan Venkatachari, the CFO of the company. Hi, Mr. Venkatachari. Thanks so much for joining in. Well, I recall when we last chatted earlier this year, you were saying that you're looking to get to mid-teens in terms of margins. Now, you've got there. Do you believe that this 15% margin odd band is sustainable? And also give us a sense on attrition. The entire sector was struggling with it. I think attrition for your company is close to 28%. Do you believe it's peaked out? Will it trend lower from here?
First on the margin side, I think we are very confident and will be sustaining these levels. And we are trying to make efforts to see that how best we can move by a couple of basis points. But I think over the quarters and not immediate quarters. When it comes to the question of attrition, I think we are currently hovering around 27% or so. We feel that it has peaked out and we have done enough of retention methodology. And we feel that it's going to go down and there are a lot of steps which are being taken. So that is going to be definitely an additional positive point for us.
Those are a couple of positive points that you've mentioned, that the margins will sustain at these levels and attrition has peaked out. Mr. Venkatachari, just wanted to understand, your outlook on the revenues itself. The first half of this year, you've done almost 39%. You've always been targeting mid to high teens sort of revenue growth. Wanted to understand what the plan for this year is. And I ask this specifically because UK and Europe accounted for a little over double digits of your overall sales. You set up an office in Prague last year to expand into that market, but currently we are seeing some sort of growth headwinds in that geography. So in light of that, what kind of revenue growth can you guide for this year, and what's the prognosis on that geography itself?
Yeah, that's a good question. Actually, we have been predominantly weighed heavily on the US markets. If you look at the quarter, probably, or the first half of the year or the quarter, if you look at it, we have been at about 92% coming from the US market and the rest 8% from the rest of the world. While it is so, basically, I think UK traditionally has been contributing close to about 7-8%, which over the last couple of quarters have taken a little bit of headwind. But we are confident that the kind of efforts which we have put in and then the kind of focus what we are trying to get through, the traction seems to be quite high. While it is so that the challenges lies ahead in terms of the UK and Europe market, the purpose of opening up a nearshore center at ZEC, which is very clearly to attract and tell the customers clearly that we are available on a nearshore on the European market, to work on their time zones very clearly. So we see a lot of tractions coming ahead, and I think in a couple of quarters probably ahead, you will see a lot of good news flowing through. Though it is not forward-looking, but I think the kind of efforts are going to culminate that way.
So what
when it comes to the question of managing the revenue, I think the growth part is intact very clearly. I think the first 6 months we have achieved about close to $101 million in terms of revenue. And we don't give any guidance, but invariably looking at the order book, looking at the run rate where we are today, I think we should be comfortable doing high teen growth, which should take us to cross the borders of 200 million for the current year.
You've already done 101 million, right, sir?
Yeah, absolutely.
So
absolutely.
200 should be par for the course, right? If you're going to be at...
Yeah, so considering all the scenarios, I think the current run rate looks very interesting, and we should be up and about 200 million.
Okay, more than 200 billion. Okay, all right. The other point is you have given a long-term vision that by 2026 you want to be, I think, a $500 million company, and 2028 you want to be a $1 billion company. That's going to be quite a tall ask, it seems. Particularly the $1 billion mark. How much of that will come in from inorganic growth? Do you have some plans out there? And also give us an update on the cash in your books, because you've been looking at inorganic growth. Go ahead.
Yeah, absolutely. If you look at, probably it's always we and the management strongly believe in setting up a target very clearly, which is a tall target, and start working towards it, which is what is always interesting and keep pushing us beyond. And if you look through about a $1 billion journey, or even a 500 million, if you look through the end state at $1 billion, probably we expect about 65% of that to come through organically over the next 6 years, and the rest will come through inorganic mode. There are various methods in terms of inorganic mode. If you look at the first 6 months, we have generated about close to 60 plus crores in terms of cash. The cash as it stands in cash and cash equivalents today is about close to 195 crores. So the next 2 quarters again will keep generating cash. So cash is not a debt, but I think there are other methodologies in terms where we can try to push through and do inorganic. But I think the inorganic, we are trying to be very choosy and picky in terms of trying to look at the value addition and the volume addition systematically. So as I speak to you, there are a lot of proposals which are reviewing. But I think as and when it crystallizes, we'll be able to get it. We are pretty confident we'll be able to get there. Please go ahead.
Yeah, just wanted to probe you a little on that inorganic part as well. I mean, if you're a $1 billion company, you would be looking at $350 million coming in from inorganic, and you yourself haven't crossed the $200 million mark yet. You are, hoping to cross it this year itself. What are the kind of proposals that you're looking at when it comes to inorganic? Because for you to be able to buy a company that scales up to $350 million, the talk should start from now itself, I presume. And secondly, how cast in stone are these $500 million and $1 billion targets? Because you've moved the goalpost once as well on this $500 million target itself.
Yeah, so to just step back a bit, probably the top accounts contribute about 20 accounts contribute about 50% of the revenue currently. With the recent acquisition of the Apparat Digital, which is Round Square, I think the doors which are opening up for the opportunities on the product development side in terms of offering digital transformation services, we see a traction which is quite high. So that is one of the confidence. The second thing is that these acquisitions, what we are talking about, is going to be tuck-in acquisition in the order of the size of about close to 40-50 million, which are in the niche areas and which has the potential to grow. And it need not be a single acquisition going to about 350 million. As we start doing one or two acquisitions out very clearly in a span, the aggregator will start and putting up to close to about 350 million. And that is how we're trying to position and put the target out very clearly. While on the organic front, I think we're extremely confident on the 20-25% plus growth over the next couple of years in terms of pushing it through with the kind of offerings what we have on the table.
Mr. Venkatachari, what about closing out one of these inorganic growth targets that you're looking at? Should we hear from you in FY23 itself? You believe you can close it? Point number one. And point number two is, the last time we chatted, when we spoke earlier this year, you were saying at current valuations, the promoter entity believes that the shares are attractive. At current reckoning, what is their view? The promoter holding has moved from around 34% to around 37%. Go ahead and answer both these two questions.
Absolutely. To that, as regards inorganic, I reserve my comment basically because we need to publish it uniformly through the exchanges. But we are positive and quite optimistic. I will leave it at that note very clearly because there is an aggressive set of evaluation which is happening around. And also keeping at the back of the mind that we have a target and we have a vision where we need to achieve. So I would like to put it out that way. When it comes to the valuation, I think we demonstrated very clearly. Still, the promoters feel that the current valuations are very attractive. Clearly, given that the kind of the numbers which are stacked up over the last 2 quarters cumulatively and where we are heading at in the current year, which anybody can do the math. I think that is one of the signified intent. We gave a buyback. We did a buyback very clearly, which shows very clearly that the company is confident of itself in the business. And still the promoters feel that the valuations are attractive and at every opportunity and point of time. So they will definitely depend to increase their stake.
Mr. Venkatachari, is there a target holding that you want to take it to from around 34%, 37%? if they're believing that it's attractive, the stock has already risen from May onwards when you said that you were a buyer to current valuation. So any particular holding, the target that you want to take it 40, 45% or something on those lines in the next couple of years?
I will not pin the percentage down, but I think very clearly that their intent is to move the inch forward and then continue to be what you call enhancing their value, enhancing the holdings.
All right, we hear you. Let's talk about a couple of your segments then. Travel and tourism accounted for a fair chunk of your revenues pre-COVID. That dipped during COVID, and the data point suggests that it's back and how beyond pre-COVID levels as well. How much does that contribute to your revenue now? How is that likely to grow? And the other two verticals, retail and e-commerce, those were also likely to be your growth drivers. How much do they contribute? What are they likely to grow at?
Absolutely. I think during the COVID time, while 28% travel contributed, I think we learned from the mistake and we have de-risk the portfolio, and BFSI and retail have really gained traction, contributing about 22 and 17%. While we have retained the relationship on the travel has contributed at about 14%. So if you look at the growth drivers, continue to be retail and BFSI. However, travel traction has now bounced back. So we are very optimistic that this growth is going to be definitely coming back to the pre-COVID levels very shortly. And we have done enough research in terms of providing the right kind of offerings and setting up the technology centers very clearly. So these three sectors will definitely contribute.
And what about your onshore-offshore mix right now? Where does it stand at? And what exactly is your onshore utilization? Offshore utilization.
My offshore utilization stands at 76.8, which is roughly about 77%. My on-site utilization is at about 96%. My resource mix is at about 22 on-site and 78 offshore. My revenue mix is at close to 51% on offshore and 49 on on-site. I'm trying to push the ant with all this visa and other region to 55% so that my margin traction can start improving, and try to cover that up with the volume very clearly. So more and more clients are intending to really push to the offshore. So that is a positive news.
All right. Thanks a lot, sir, for joining in. Always a pleasure speaking with you. Wish you good luck. And also season's greetings to your team members and your family as well. With that, we step into a short break. On the other side, a whole host of stocks, they're reacting to earnings. A detailed fine print of all those numbers. From Chennai Petro, we have PCBL, Gland Pharma, all of them on our radar. Welcome back. You're watching us here on Chartbusters. Let's get chatting about a lot of numbers. Philips Carbon and Chennai Petro, both of them are trading with deep cuts in reaction to their second quarter numbers. Sonal joins in to tell us more. Sonal.
Thank you for that. Well, for PCBL or Philips Carbon, it was a margin miss, though the revenue grew strong. Revenue growth was strong at 52%. Came in at 1,627 crore rupees, but EBITDA was up just 1%, leading to a margin decline of almost 600 basis points at 11.6%, and profits were down by 4% as well. Now, company said that volumes declined on a YOY basis in Q2 due to capacity constraints, and Chennai facility, which is the next leg of their expansion, will be commissioned by December 2022, and the peak utilization there will come in 2 years. Now, what really impacted their volumes this time around? It was the European region. It contributes 18 to 19% of the carbon black market, and for companies' exports itself, it's around 15 to 16%. Production challenges were seen in the European region because of higher power costs, and that is something which impacted numbers for the company this time around. Chennai Petroleum too, very weak set of numbers. We've been talking about how Singapore GRMs have fallen from the peak. Crude prices are lower as well, and that's why an inventory loss and forex loss impacted the numbers. Revenues are down 16%, EBITDA down 93%, leading to a margin decline of almost 1,300 basis points, and profits were down 99% on a quarter-on-quarter basis. Even GRMs for them came in at $4.4 per barrel versus $25 per barrel. So they have seen a massive decline in GRMs as well, and that's why the big fall in the stock price as well.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Ekta. She's here to tell us about Gland Pharma. That stock as well is getting absolutely pummeled, down more than 10%. Ekta?
Thanks. Well, yes, definitely another disappointing quarter which is coming for Gland. Revenue is down 3%. Street was anticipating a 9% decline. So that's better than expectations. But really what disappointed was the margins, which came in at 28.4%. The Street was expecting them to maintain that 30% plus run rate that they have been doing. So the Street was anticipating around 31% in terms of margins. Profit also missed expectations of around 250 odd crores. Q on Q, yes, there was a recovery, but overall it was still a miss based on what the Street was anticipating. Core markets such as the regulated markets, which is basically the US, Australia, Canada, was up 3% this quarter. So that was a positive as compared to last quarter's performance. India continued to decline because it was impacted by factors such as a high base as well as supply disruptions. Last quarter, it was down 70% year on year. This quarter, it was down 40% on a year on year basis. What has supported Gland? Net cash is strong, 3,800 crores plus. Stock has already corrected over 50% if you count today's correction at current reckoning from its 52-week high. It's trading at around 21 times now, 1 year forward in terms of a PE. Now, brokerages are also quite sanguine and disappointed, you'd have to say, with Gland. For example, Bernstein, it has an outperform rating, but they've cut their target price. Goldman Sachs has maintained buy, but they've cut their target price. Incred too has cut their target price on the stock. And Citi, which has a sell, too has cut its target price to 1,920 odd rupees. The likes of Jefferies has downgraded the stock to hold, and they've cut their target price to 2,241 as well. Overall, brokerages say that the Q-on-Q recovery has been reported, but like I mentioned, the margins disappointed, and the likes of Morgan Stanley say that they expect a resumption of growth and strong IP visibility in FY24 to help in terms of the stock going forward. A lot of the brokerages such as Incred, Goldman Sachs and Jefferies have cut their earnings as well as EPS estimates.
Take that point, Ekta. Thanks a lot for that. Meanwhile, just keep an eye out on a couple of stocks. We have some weakness seen in a few of these FMCG names. Asian Paints at the low point of trade because crude, remember, has spiked to almost $96 per barrel now. The other one, which is lower in trade, is Nestle. Had seen a big run post its numbers and now some profits being taken off from record highs on that counter. We also have Crompton from the broader markets, which has actually now just slipped into the red at the low point of trade. That's on account of the numbers that came in on Crompton. On most parameters, it was a miss on estimates. So that stock seeing some bit of profit taking. With that, we're out of time on this edition of Chartbusters. You stay tuned to CNBC-TV18. Trading Hour comes up next.
I think selectively there are still stocks that are lagging. I mean, obviously, we've talked in the past about the Indian IT names. Those have lagged a lot, but that's not necessarily where I would be putting money to work. The bank stocks have obviously had big moves, but I think there are still selective opportunities in the banking space because they're not from a valuation standpoint. If this is a long-term sustained earnings and growth cycle in India that has several years to go, which I think it does, then banks are certainly not at valuations, at least some of them, where we can say that they're already fully priced all the good news. So therefore, I look at valuations rather than indices to see where individual stocks are.
Brought to you by Big Bow